The opposite of that, which is a company called Chord Energy, which I've been wanting to talk about for ages, but then we got into earnings season. There was so much other stuff to talk about, and it's constantly been on the end of our list of stuff to talk about on the show, and we never really get there. So here we go. This time, it's an oil company, Steve. And I think a prerequisite for any kind of oil company is that you need some sort of positive view on oil prices. I won't blast through a kind of oil macro overview here and the reasons that you might not have that. But suffice to say that if you think oil prices, if you're bearish on oil prices, certainly over the mid to long term, never mind the next few months or even maybe the rest of this year. But if you're bearish on that, you should probably not really look at any oil stocks, including this one. But if you have a positive view, and by that I mean, let's suppose it's currently at about $71 WTI, and if you think it's going to stay above 70 by and large over the next decade, this one might be worth thinking about. So let's start somewhere else for the moment. Warren Buffett's been buying Occidental Petroleum. People keep wondering sort of why, and the answer isn't entirely obvious, but Monish Pabrai recalls a conversation with Charlie Munger, because this is basically all he does, but he remembers Charlie Munger once saying that he would like to buy ExxonMobil. But he would like to buy ExxonMobil and make the management promise they were going to stop spending their money on doing exploration projects. What they were going to do was just drill the damn oil out the basin and send the cash back to shareholders. But they won't do that. So they didn't buy ExxonMobil. His idea was that, look, we can generate good enough cash flows off the oil that we currently have. The trouble is, you people aren't going to return it to me. You people are going to go and do some other weird stuff with it. And I don't want you doing weird stuff with it. I want you to give me the money. It's in this similar sort of spirit that I'm looking here at Chord, but in a different kind of location. It's not based in the Permian, which is less good. It means extraction costs are higher. More on that in a second, but it's a similar sort of idea. The company has a rule that if their leverage ratio, i.e. their net debt to EBITDA, is below 0.5, then they're going to return 75% of their free cash flow per year by a combination of dividends and share buybacks. And it currently is at that level. It's currently at 0.3. So more back on that returns policy in a bit. But this is a company that isn't planning on going off doing speculative drilling projects that may or may not result in anything other than cash going out the door. It's a company that's interested in extracting oil and sending you the money for it. So they're based in the Williston Basin, which if you look at a map of the States is basically at the top in the middle, and the costs there are much higher than they are in the Permian. Here is the big red flag that I have with Chord. They don't say what their break-even price of oil is. They say it's low, and that's not a number, and I don't know how low, but here's what they do say. At $70 a barrel, which is where I said I think you need to think oil is going to be if you're going to think about oil companies in general, they reckon they can return $13 a share with their current operations. Their current share price is 113, so that's about an 11.5% return. They prefer buybacks to dividends at the moment, and that's the policy that I agree with, although they have a dividend policy. It's kind of, I mean, the policy itself is fixed, but exactly where it comes down depends on where prices are for oil and so on. So they made a big acquisition recently, and that's a general theme of the Williston. They are the largest independent producer left there. Everything else has been bought by Marathon or Exxon or Chevron or whoever. And at the moment, it's Chord that's the largest independent producer left. That boosts their inventories, it expands their operations, and they have somewhere they reckon in the region of just over 10 years worth of inventory down there to drill out. And their preferred growth method is not by drilling stuff, it's by smart M&A. So finding proven reserves and paying for them rather than going to try and drill your own and hoping you strike something. The net debt's currently 0.3. Other oily companies tend to be net debt to EBITDA of around 1. So the downside with this is, so the upside of this is if oil prices stay where they are, you stand to collect about 10% a year for a fairly long time, all things being well. If they don't, this could all come unravel quite quickly. So oil prices come down, then you get a dual effect weighing on you the other way. First things first, your leverage ratio changes. So your EBITDA goes down, so your net debt to EBITDA changes. You make less money coming in via cash earnings, and your dividend policy changes. You go from paying out 75% of your free cash flow to, if you're below 1 times levered, you go to 50%. If it goes above 1 times levered, you get $5 back, which is 4.5% less than that once you knock off withholding tax for a UK investor. So things can go very right or very wrong in a hurry, but this is a kind of fairly punchy leveraged thing. And at the moment, things are lined up quite nicely for Chord, and I don't think that's currently reflected in their share price. Whether it should be is another question. What do you think, Steve?
It's interesting to come across a stock that's trading at what's like 6 times earnings. Is it something like that with the oil price that it's not a spectacularly high amount by any stretch of the imagination, nor has it been particularly high for a while yet, Steve. So really interesting to see that, but it's had a really flat period essentially since 2021. It's essentially done nothing in terms of return because it's a dividend stock. Essentially, it's giving you a return back to you in terms of this 10% return or nine. I think it was a 9% return last year. So that's pretty interesting to me, Steve. I don't know an awful lot about it. In fact, the first time you sent it to me, I actually said out loud, "What is Chord Energy?" So that shows you how much I even thought about it, especially as I work with chords in my day job as well. I still read it as Chord. But yeah, it is interesting. I do think the amber flag, I think I would call it, not telling you about their where the break even level for barrels is interesting. I think my big worry for it here, Steve, is well, there's two things really, isn't it? There's this huge ramp up in oil production and refining that Trump and his administration want to do. That could be one of the reasons we're seeing this depressed stock price. But the other thing I would point out is that this is just a 7 billion company trading at 6 times earnings, and like you say, Steve, it's the biggest independent operator in its area. But that means nothing to the likes of ExxonMobil or Chevron or someone like that who just wants to come along and be the big Goliath and swallow them up. But I suppose, Steve, that at this sort of price, you don't really care if they come along and do that with a 20, 25, 30% premium. That would be job done for you, would it?
I think I would be okay with being taken out 20% above in this situation. I'm sort of hoping for better over time, but this isn't like the Dowlais thing that we talked about. Both of those ideas basically are from the same person, actually. A guy called Conor Maguire over at Value Sits, short for Value Situations, if you're interested. Unlike you, by the way, I first heard about this company by hearing the name, so I immediately went off and misspelt Chord. I leaving out the H in it when I tried to look up the business. I found it soon enough, but yeah, they're not levered. There's a few macro kind of worries that you can get into here. One being Trump loosening constraints on US production. I mean, Chord is a US producer. They should be helped by lower taxes in that regard. The other issue is that Saudi has been holding down their production for a long time. They're the second biggest producer globally behind the US. If they decide they don't want to do that, the net effect for them has been that OPEC, their apparent OPEC colleagues, have been robbing them blind for however long by basically saying, great, thanks, Saudi. We're going to keep producing stuff and just make more money while you don't. And if they decide, well, we need to make some more money because we're trying to get this moon up in the sky around our city, then that could also tilt oil prices quite a bit lower. Add to that plenty of scope for better political stability. And I wouldn't blame anyone if they had a negative view on the oil price from here. If you don't, however, and you think over time it's likely to hold above 70 or so, then I think this is interesting. I mean, it's similar-ish to Occidental, maybe. I don't quite know what Buffett sees in that thing, but I'm not going to try and read the man's mind. I spend enough of my day trying to do that. I'll plough my own furrow with Chord, which regular viewers of this show might remember was in my quote-unquote 13F at the end of last year. I'd started buying it before then. At the time, I was quite handily up on it. Now I get round to reporting it to you, I'm quite handily down on it. But such is the way of things. It may or may not come back. We will see. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.